On May 5, 2026, the Reserve Bank of Australia delivered another blow to mortgage holders, raising the official cash rate by 25 basis points to 4.35%. This is the third hike this year alone, marking a definitive hawkish turn by the central bank, as the four major banks prepare to pass this increase on to consumers immediately. The property crash headlines have returned with a vengeance. Some media outlets are predicting a 15% drop by 2030, with worst-case scenarios suggesting a 40% collapse. But is this a data-backed reality or just sensationalism? Today, we're going to strip away the noise and look at the actual numbers from headline CPI versus trimmed mean inflation to the chronic undersupply of housing. If you're looking to buy or invest in the Australian market, you need a strategy based on logic, not fear. To understand where the market is going, we first need to understand why the RBA acted. The March 2026 CPI came in at 4.6%, the highest since late 2023. At first glance, it looks like inflation is spiraling out of control. However, a deeper dive into the data reveals a significant external shock fuel prices. Automotive fuel jumped over 30% in a single month due to geopolitical tensions in the Middle East. The RBA's concern isn't just the price of petrol, it's inflation expectations. When businesses and consumers start believing prices will keep rising, it becomes a self-fulfilling prophecy. The RBA hiked rates primarily to crush this psychological shift before it became entrenched in the economy. Here's where it gets interesting for the analytical investor. The RBA focuses on trimmed mean inflation, a measure that filters out volatile items like fuel. The trimmed mean rose only 0.8% for the quarter, or 3.3% annually. This is exactly where it was in February. While headline inflation looks explosive, core inflation is actually behaving. Furthermore, service inflation is beginning to decelerate, suggesting that internal domestic demand is cooling down. This means that while the May hike was inevitable, given the headline numbers, predicting a continuous climb to 4.85% or higher might be premature. The data suggests we are seeing a battle between external supply shocks and cooling internal demand. Let's address the elephant in the room, the 40% crash forecast. These reports often use primary research modeling. If you read the fine print of the most probable scenario, the model doesn't predict an immediate crash. Instead, it suggests prices will continue to rise until mid-2027, before a 15% correction occurs toward 2030. Think about that. If interest rates were going to break the market today, prices wouldn't rise for another 14 months. History also offers a lesson. During the COVID-19 lockdowns, experts predicted a 30-40% drop. Instead, we saw one of the largest growth cycles in history. Sensationalist headlines sell clicks, but they rarely reflect the complex mechanics of Australian real estate. If a massive crash were imminent, the first institutions to panic would be the big four banks. Residential mortgages are the largest assets on their balance sheets. Yet CBA is forecasting a 5% increase in 2026, and ANZ is predicting a modest 2.8% gain. They are looking at arrears rates, employment data, and household buffers. While Morgan Stanley warns of a wrecking ball effect on consumer confidence, the domestic banks remain cautiously optimistic. They see a market that is slowing down, yes, but not one that is structurally failing. For a technician or a professional, this means looking at the market as a correction or stabilization phase rather than a collapse phase. Why won't the market collapse? It comes down to the most basic law of economics, supply and demand. Australia is facing a chronic housing shortage. High construction costs, labor shortages, and slow planning. Approvals mean we aren't building enough homes to keep up with population growth. We saw this in 2022 when rates went up. Sydney and Melbourne dipped, but Perth and Brisbane surged. Why? Because the supply-demand imbalance in those cities was stronger than the interest rate pressure. Today, we see the same pattern. Sydney and Melbourne are slightly negative, 0.1% to 0.2%, but Perth is up 1.5%. You cannot analyze this market by looking at interest rates alone. You must look at the inventory. So what is the professional move? First, if you have a pre-approval, re-verify it. Your borrowing capacity has likely dropped since the hike. Second, conduct your own stress test. Can you manage your mortgage if rates hit 4.85%? Third, stop waiting for a perfect time that may never come. In Australia, the cost of waiting often exceeds the cost of the mortgage. While the media focuses on fear, the smart money focuses on logic. Check the cycles of each city, look for undersupplied pockets, and focus on long-term capital growth. The RBA's move is a hurdle, not a wall. Stay analytical, stay prepared, and I'll see you in the next update. Don't forget to subscribe for more data-driven insights into the Australian market.